Depreciation. Depreciation is the first chapter. Depreciation means decline or reduction in the value of fixed asset is called as depreciation. Mm, Let's see the meaning. Depreciation means a gradual and continuous reduction or decreases in the value of fixed assets due to wear and tear, lapse of time, obsolescence, and permanent fall of market price is nothing but what depreciation means: continuous reduction in the value of the fixed asset due to wear and tear. Wear and tear is nothing but the continuous usage, the constant usage of the assets. Lapse of time. Lapse of time is the passage of the time. Obsolescence. Obsolescence is nothing but what? The invention of the new things or the substitute of new things. That time it has to be depreciated. And the permanent fall of the market change or the market prices. Permanent fall of market price, it leads to a depreciation. Method of charging depreciation. Mainly there are six methods of charging the depreciation. First one is straight line method, second one is written down value method, third one is annuity method, fourth one is depreciation fund method, fifth one is insurance policy method, and the last one, sixth one, is revaluation method. The first three methods are very important for your 14 marks questions in your annual exams. They ask 14 mark questions on these three methods: the first, the straight line method, and the written down value method, and annuity method. Let's start with the first method, that is straight line method. Straight line method is also called as fixed installment method, equal installment method, and original cost method. According to this straight line method, depreciation for 12 months during the entire life of the time of the asset will be fixed. Here, the depreciation will be calculated at given percentage on the original cost of the asset every year. We have to calculate the annual depreciation with the help of this formula. So that is annual depreciation equal to the cost of asset minus scrap value whole divided by estimated life of the asset. Let's take an example. A company purchased machinery for rupees 5 lakh. Its life was estimated to be 10 years with a scrap value of rupees 10,000. Find out the amount of annual depreciation. Okay. They purchased the machine at cost of rupees 5 lakhs, and the scrap value is 10,000, and the estimated year is 10 years. So according to our formula, annual depreciation equal to cost of asset is 5 lakh minus scrap value. The scrap value is 10,000 rupees. The scrap value whole divided by the 10 years. They given the estimated to be the 10 years life. So that is 10 years is equal to 5 lakh minus 10,000 is 4 lakh 90,000 whole divided by 10. So that is 49,000 rupees. This 49,000 rupees is a annual depreciation. So let's start with a sum on the straight line method. So first problem, a firm brought a machinery on 1/4/2010 at a cost of rupees 60,000. It decided to write off depreciation at 10% per annum on straight line method Show the machinery account and depreciation account for 3 years. So this is the question. Solution for this sum, they ask machinery account and the depreciation account. So machinery account and depreciation account. So we start with the machinery account. So this is the machinery account. This is debit side and this is credit side. This column is date column, this is particulars, and this is amount. Same as for the credit side, date column, particulars column, and amount column. Okay, let's start. See the problem. A firm purchased or brought a machinery at the cost of rupees 60,000, and they given the depreciation percentage is 10 percentage per annum, and and they says 3 years entry. We have to write the 3 years entry. Okay, let's start. On date is on 1 4 2010. So we have to write the date here, 1 4 2010. So I write the date in this method. So this is the date, and this is the month, and this is the year. Okay, 1 4th, the 1st of April 2010, they brought the machine at cost of rupees 60,000. So they brought the machine. So machinery account is the real account. So we real account is debit what comes in. So we have to purchase the machinery account. So machinery account debited to cash or bank account. So I write here bank account to bank account at cost of rupees 60,000. So 60,000 rupees. Okay. Then at the end of this year 2010, at the end of this year, we have to write the depreciation. So this is the financial year 1 4 2010 is the started with the 1st April to the 31st March is the financial year, and 1st January to the December 31st, that is the calendar year. So here they given financial year. So we start with the 1st April 2010 to end date is 31st March 2011. This is a end date of the this year. Okay, by depreciation, by depreciation account. So the amount is, they purchase the machinery at cost 60,000. So 60,000 on 10%. 60,000 on 10% is 6,000 rupees. 6,000 rupees, that is depreciation amount, and this has to be balanced here. Close this account, close this, that year amount is, so 60,000, and here also 60,000. Then 60,000 minus 6,000 is 54,000. 54,000 rupees, that is by balance carried down. This balance 54,000 has to be continue with the next year, that is the next year opening balance. So here we write the date is here the same date, 31st March of 2011. Okay, here the same date. Here the opening of next year is 1st April 2011. Okay, 1st April 2011 is the next year opening. So here to balance brought down rupees 54,000. Okay, next year brought down is 54,000 rupees. We have to write here. Then depreciated amount at the end of the second year is the 31st March 2012 is by depreciation account. So amount is same. So because 10% on 60,000, 10% on 60,000 is 6,000. That is same. Okay. This is the straight line method. This year, the last first year is also the same percentage of depreciation, and that has to be continued with the second year also. That is 10% on 60,000. That is 6,000. Then balancing this figure, so 54,000 and 54,000 here also same. 54,000 minus 6,000 is 48,000. That is by balance carried down. Date is also same date, 31st 3 2012. And the closing balance of this year is opening balance of the next year. That is 1st April 2012 to balance brought down amount is 48,000. And they ask the 3-year entry, so that's why we're doing 3 years. This is first year, this is second year, and this is the final and last year. So 48,000, this has to be ended at the date 31st March 2013. Okay, 2013 by depreciation account. By depreciation account, same we calculate 10% on 60,000. So we write here 6,000 rupees, and balancing this figure 48,000. Here also same 48,000. 48,000 minus 6,000 is 42,000. 42,000 is a balancing figure. So here by balance carried down, 42,000 rupees, and this has to be closing, and this has to be opening at the next year is 1st of April 2013 to balance brought down. Okay, to balance brought down, that is 42,000 rupees. 42,000 rupees. This completes the machinery account. See how it looks. So this is the depreciation account. Depreciation account format is also same, debit, and this is the date column, and it is particular column amount, and same as that of date particulars amount. This is credit side. Okay, this is depreciation account. So we did the depreciation account at the end of the every year. So here we write by depreciation account which date 31st 3 2011. So we write this date as here 31st 3 2011. So by depreciation account, this is machinery account to a machinery account. So here we write depreciation account debited to machinery account. To a machinery account, amount is 6,000 rupees depreciation. So 6,000 rupees. So we have to close the depreciation account by transferring the depreciation amount to the P&L account. So P&L account is profit and loss account at the end of the year. So that is the same date 31st 3 2011 by profit and loss account. By profit and loss account. We have to transfer the depreciation account amount to the P&L account. So here same 6,000 rupees. That 6,000 and 6,000. Here we close the account. 6,000 and 6,000. 6,000 rupees machinery account. This is depreciated 6,000 rupees. This 6,000 has to be transferred to P&L account. So there is no opening and closing balance here. Okay. Then next year is the date 31st 3 2012. This is the second year date, second year end date, that is 31st March 2012. So say to machinery account, amount is 6,000 rupees. So 6,000, and this 6,000 has balanced here, and this has 6,000 has transferred to the P&L account. At the date end of the second year date is 31st 3 2012 by profit and loss account. By profit and loss account 6,000 rupees. So it has balanced. And the last year is third year. So this is depreciation account 31st 3 2013. So 31st 3 2013 to machinery account, that is 6,000 rupees. 6,000, and it has to be closed and transferred to P&L account at the end of the year. So profit and loss account, by profit and loss account, so that is 6,000 rupees, and it has to be closed, and 6,000 balanced. So it finished the sum. See how it looks. This is the machinery account and this is depreciation account. For they asked the 3 years, so I have written 3 years entry.